Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Like and subscribe!
Micron this week's dip is a gift. This article was written by RI Research. Summary. Micron Technology remains a top AI picks and shovels play, directly benefiting from surging AI data center capex by tech giants. Micron's margins are expanding due to an unprecedented AI memory chip shortage, with further tightening likely as 2026 capex accelerates. Despite a 4x share price increase in 12 months, Micron trades at an attractive 11.5x FY 2026 forward PE, supported by robust EPS growth. Micron boasts an A+ quant grade and a fortress balance sheet, with $10 billion cash, $12 billion debt, and $59 billion equity, underscoring undervaluation. Reasons to continue buying MU. Micron MU is down by 10% since its recent peak levels due to this week's panic, but it is up by a massive 55% since November, when I shared my bullish outlook. The recent sentiment-driven sell-off doesn't affect my long-term bullish stance, because the week was actually excellent for Micron's business. As I said in my previous thesis, Micron is a pure AI picks and shovels play, because the company's data center business is rapidly expanding. There are four largest AI infrastructure spenders in the world: Amazon, AMZN, Google, Microsoft, MSFT, and Meta, META. All these companies have already released their calendar Q4 2025 earnings, and none of them said that they plan to cut AI capex plans. In fact, all of them are set to significantly boost investments in 2026 compared to 2025, as they already see that investments in AI are providing synergies. The latest Q4 earnings out of these four companies were released by Amazon, which occurred just yesterday. The world's cloud infrastructure leader is eager to confirm its status and is ready to invest a staggering $200 billion in consolidated FY 2026 capex. And the management said that the lion's portion of this budget will be allocated to AWS, i.e. to data centers. Google released its earnings a day earlier, on February 4th, and their 2026 capex budget is not very much lower than Amazon's in relative terms, something around $180 billion. If we add Meta's FY 2026 capital budget of approximately $120 billion, we get $500 billion that will be spent by only three companies. I didn't find the explicit capex amount for calendar 2026 from Microsoft, but given ambitious plans of major rivals, I think that they plan to spend more than $100 billion as well. Therefore, all four giants are likely to spend $600+ billion in capex in calendar 2026. If we assume that 80% of the total capex will be allocated to AI data centers, it means $480 billion allocated to AI infrastructure. Of course, investors of these four giants are very concerned about returns from these massive investments in AI infrastructure. These concerns are fair because these four companies became Wall Street darlings mainly because of their stellar historical returns on invested capital. To maintain their reputation as profitability powerhouses, their profits must grow at least with the same pace as their capex growth. Before the pandemic, the total cumulative capex of these four giants was approximately 10 times lower than the 2026 forecast $65 billion. Therefore, to maintain their stellar ROICs, these companies' net profits must also soar by approximately 10 times compared to pre-pandemic levels. I am not saying it is impossible, but it will certainly be a challenging task. Therefore, I am not surprised that these stocks are suffering sell-offs. However, we are talking about Micron right now, the company that directly benefits from soaring AI capex. The company cited an unprecedented AI memory chip shortage before the big tech's Q4 earnings season. Considering the fact that all the major players plan to invest even more in data centers in 2026, the shortage is poised to become even worse. We all know the basics of business, which say that vendors usually capitalize on shortages as they are able to exert massive pricing power in these circumstances. Therefore, Micron's aggressively expanding gross and operating margins are highly likely to maintain their robust momentum. Surely, there is always the risk that big tech might reconsider their 2026 AI capex plans. However, the fact that business leaders across the world are ready to double their spending on AI capabilities, even if they don't see immediate results, is a strong support for the assertion that tech giants are highly interested in winning the AI infrastructure race. We are amid one of the major technological revolutions in the history of humanity, and I don't think that any of the aforementioned tech giants wants to fall behind in the AI era. Therefore, this fierce competition will force them to maintain aggressive AI capex plans, even considering the cautious stance from investors. And the very best part is that Micron is still substantially undervalued, even after the 4x share price growth over the last 12 months. It means that the company's EPS growth revisions have been outpacing the share price so far, which maintains its forward PE ratio setup extremely attractive. The estimated FY 2026 forward PE is just 11.5, which looks more like a healthcare or consumer defensive stock. There are no fundamental reasons that can justify such a low forward PE, as Micron has an A+ quant grade spanning growth, profitability, and momentum. Moreover, the balance sheet is a fortress with a $10 billion cash cushion and only $12 billion in total debt, which is extremely low compared to Micron's total stockholders' equity of $59 billion. To sum up, paying 11.5 forward earnings for an AI infrastructure picks and shovels play with a clean balance sheet and stellar profitability looks like an absolute gift. Therefore, I expect a sharp MU rebound very soon. Reasons to avoid MU. To address the soaring demand for memory chips, Micron also needs to boost investments. In January, the company announced 3 major expansion projects: an advanced wafer fabrication facility in Singapore, with $24 billion expected to be invested over 10 years, acquisition of a PSMC fabrication site in Taiwan for $1.8 billion, and a massive 100 billion megafab in New York. The latter is also a long-term project, meaning that this amount will not be invested at once. Therefore, it is not the same compared to hundreds of billions expected to be invested by hyperscalers in 2026 alone. Nevertheless, these are large projects even considering Micron's $430 billion market cap. Given that in previous years, Micron's annual net capital spending was approximately $10 billion, the aforementioned new projects are unlikely to lead to a 10 times increase in capex. However, the company's capex will certainly increase amid the soaring memory chip demand, meaning that ROIC compression risk is also applicable to MU. It is significantly lower compared to hyperscalers, but it is still notable. And the biggest risk is that Micron doesn't have much room for error while executing these ambitious expansion projects. The reason is simple. There is a fierce competitor, Samsung Electronics, SSNLF. Recent reports suggest that Micron's main rival in memory chips is nearing NVIDIA certification for HBM4 chips, which will intensify competition further. Therefore, not completing its expansion projects on time might lead to the situation when Micron will be using vendor contracts with Samsung, while its facilities are not completely ready for mass production of memory chips. Therefore, competition risk is also significant. The verdict: I am happy and grateful for this week's 10% dip, as it allows me to buy this massively undervalued high-quality stock a little bit cheaper. Micron.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.